Most traders believe progress looks like activity. Screens lit from morning to close, orders fired daily, notes filled every night. It feels responsible, it feels disciplined, and it feels wrong, though most people don't notice that until it's too late. Because the traders who last don't trade every day. They don't even trade every week. Some months, they trade fewer than 5 days. That number sounds suspicious. 5 days out of 20. Pause here. Let that land. If you've been taught that mastery comes from repetition, this feels backwards. If effort equals time spent, this feels lazy. And if your self-worth is tied to participation, this feels threatening. That discomfort is the point. It's where the real lesson begins. This is timeless market lessons, where market wisdom outlives markets. What follows isn't a productivity trick. It isn't a schedule hack. It's a hard-earned shift in identity, one that came after nearly losing everything. Here's the contradiction most traders avoid. The market doesn't reward effort. It rewards alignment. And alignment doesn't show up daily. This is where traders usually get it wrong. They confuse being present with being prepared. They assume that more observation creates more opportunity. In reality, constant exposure dulls judgment. Noise becomes familiar. Risk starts to feel normal. A brief story. There was a trader who once believed the market demanded daily attention. He tracked every move. He stayed close. He acted often. And for a while it worked, until it didn't. Losses piled up quietly, not from recklessness, from over-participation, from being involved when nothing demanded involvement. That trader was Jesse Livermore. He didn't learn restraint in a classroom. He learned it through near bankruptcy, through cycles where activity felt logical, even necessary, and still destroyed him. Only later did he realize the damage wasn't from bad trades alone, it was from unnecessary ones. Here's a pattern interrupt. Question to you, directly. How many of your recent trades were taken because the market demanded it, and how many because you were already watching? Most people don't notice this distinction until it's expensive. Livermore eventually recognized something uncomfortable. His best results didn't come from frequent decisions, they came from rare ones, from moments when the market aligned with his preparation so cleanly that action felt almost forced. Everything else was erosion. This reframes the entire philosophy of trading. Waiting isn't inactivity, it's selection. Restraint isn't hesitation, it's filtration. But here's where the identity threat sharpens. If you're only trading 5 days a month, what are you doing the rest of the time? This question unsettles people because it exposes a deeper assumption that being a trader means trading. It doesn't. Being a trader means being ready to trade. Those are different identities. Silence pause. 2 seconds. When Livermore stepped back from daily participation, it wasn't because he lost interest. It was because he learned that presence creates temptation, and temptation erodes rules quietly. You start justifying entries that wouldn't survive distance. Another interrupt. Perspective shift. Imagine a surgeon who insists on operating every day to stay sharp. We'd call that dangerous. Markets are no different. Precision improves with selectivity, not repetition. There's a stat traders rarely discuss. Most institutional profit comes from a minority of days. A small cluster of sessions drives the majority of returns. The rest are noise, chop, distribution, reversion. Capital leaks there, not dramatically, but consistently. Here's the uncomfortable part. Those days are only obvious in hindsight, unless you've trained yourself to wait. Livermore's framework shifted from participation to patience. He stopped asking, "What can I trade today?" and started asking, "Is this one of the days that matter?" Most days failed that test. At the time, it felt illogical. Sitting out felt like missing out. Screens were still moving, stories were still loud. But distance restored clarity, and clarity changed his behavior. Story insertion. There were months where he watched price move and did nothing, not because he was unsure, because he was sure it wasn't time. Those months preserved capital. More importantly, they preserved decision quality. When alignment finally appeared, his conviction was clean, undiluted by fatigue. This is the philosophical shift most traders resist. Markets don't reward attention, they reward timing. Another pattern interrupt. Ask yourself this quietly. Do you believe waiting is a skill or an absence of one? Most traders treat waiting as a gap to be filled, with indicators, with opinions, with trades. Professionals treat waiting as the work itself. This changes how you measure progress. Instead of counting trades, you count avoided mistakes. Instead of screen hours, you track clarity. The calendar empties, the mind sharpens. And here's the identity threat fully exposed. If you're only trading 5 days a month, you stop feeling busy, you stop feeling important, you stop getting the daily dopamine of action. What remains is judgment, and judgment can't hide behind effort. This is why most people never adopt this approach. It removes the comfort of activity. It forces you to confront whether your edge is real or whether motion was masking uncertainty. One more interrupt, stat call out. Most professional traders spend the majority of their time not trading, studying, reviewing, waiting. The trades themselves are the smallest part of the job. If this resonates, subscribe. We explore these patterns weekly. Livermore's lesson wasn't about frequency. It was about dignity, about respecting the market enough not to force interaction, about accepting that the best decision is often no decision at all. And that brings us to the number that started this conversation, 5 days. Not a rule, a result, a consequence of filtering aggressively, of saying no repeatedly, of understanding that opportunity isn't evenly distributed across time. The pattern repeats, always. Those who trade daily confuse movement with meaning. Those who wait learn the difference.
You tell yourself you're being disciplined. You're showing up, you're staying connected. The market opens, and you're there. The charts move, and you feel informed. Sitting out starts to feel irresponsible. This is where the real struggle begins. Because restraint sounds noble in theory. In practice, it feels like doubt. It feels like hesitation. And over time, hesitation starts to itch. Here's what actually happens inside the trader's mind. You see a setup that's close, but not exact. The structure resembles what you're waiting for. The risk looks manageable. You tell yourself you can start small. You rationalize that participation keeps you sharp. The decision feels controlled. It isn't. This is the inner conflict Livermore wrestled with for years. Not greed, not recklessness, familiarity. The slow erosion of standards through constant exposure. Pattern interrupt. Perspective shift. Risk doesn't increase only when position size increases. It increases when standards slip. And standards slip fastest when you're always involved. Losses from these trades don't hurt much individually. That's why they're dangerous. They bleed confidence quietly. They train you to accept mediocre alignment as normal. Over time, your reference point shifts. What once felt marginal now feels acceptable. Another interruption. Question to you. When was the last time you passed on a trade that looked almost right and felt uncomfortable doing so? Most traders answer that with silence. Here's the psychological trap. The market rewards participation just often enough to reinforce bad habits. A marginal trade works. You feel validated. The rule bends again. Soon, the exception becomes the pattern. Livermore lived through this cycle repeatedly, periods of discipline followed by periods of erosion. Each collapse wasn't caused by one catastrophic decision. It was caused by a series of small, justified ones. Story insertion. There were stretches where he traded frequently, convincingly, and still lost money. Not because his read was wrong, but because the environment didn't support it. Volatility was scattered, trends were fragmented. His edge required compression and release. He was acting during expansion without direction. This is the moment where most traders double down on effort. More screens, more tools, more opinions. They think confusion is solved by information. It isn't. Confusion is solved by distance. Silence pause. 2 seconds. Distance does something subtle. It restores proportion. When you're not constantly engaged, you see patterns across time instead of moments. You stop reacting to ticks and start noticing phases: accumulation, transition, expansion, exhaustion. Here's the realization that changes behavior. The market isn't offering opportunity continuously. It's offering it episodically. And those episodes are separated by long stretches where capital is safest doing nothing. This is where Jesse Livermore's framework finally stabilized. He stopped evaluating trades individually and started evaluating environments. He asked whether conditions justified participation at all. If the answer was no, the trade didn't matter, no matter how attractive it looked in isolation. That's the decision framework most traders never build. They decide on trades. Professionals decide on regimes. Another interrupt. Stat callout. A small percentage of trading days account for the majority of directional movement. Miss those days and you miss returns. Trade outside them and you accumulate friction. Livermore's 5 days weren't scheduled. They emerged. They were the natural outcome of filtering by environment, structure, and timing simultaneously. When all three aligned, action followed. When any one was missing, restraint remained. This reframes patience completely. Patience isn't waiting blindly. It's constant evaluation without commitment, watching without attachment, preparing without forcing. The emotional conflict doesn't disappear here. It just becomes manageable. You still feel the urge to act. You still see others posting trades. You still hear narratives forming intraday. But now you have a higher order rule. Participation is earned, not assumed. If this is landing for you, the channel is built for listeners like you. Consider subscribing. The realization is quiet. That's why it lasts. You stop measuring success by how often you're right. You measure it by how rarely you're wrong when it matters. You accept that inactivity is not a failure state. It's a position. And with that acceptance, something unexpected happens. Confidence stabilizes. Not the loud kind, the kind that doesn't need reinforcement, because you're no longer dependent on daily feedback from the market to validate your identity. You're no longer a participant searching for opportunity. You're an observer waiting for permission. That distinction changes everything.
Application changes less than people expect, and more than they're prepared for. There's no dramatic shift, no new indicators, no complex systems layered on top. The biggest change is subtraction. Fewer decisions, fewer alerts, fewer reasons to act. The day starts quietly. You still wake up early, but not to chase overnight moves. You scan broader conditions first: volatility regimes, market tone, where price sits relative to longer structures. This takes minutes, not hours. Most mornings end with the same conclusion: today is not one of the days. That's not disappointment, it's clarity. Pattern interrupt, perspective shift. The amateur asks, what can I trade today? The professional asks, is today tradable at all? Daily execution becomes simpler because the filter is higher. You're not refining entries every morning. You're deciding whether entries are even allowed. If the environment fails the test, execution ends before it begins. This is where the 5 days reveal themselves. They don't announce their arrival. They feel heavier. The tape changes character. Moves stop retracing cleanly. Price starts accepting higher or lower ground. When you've waited long enough, this stands out immediately. On those days, preparation feels obvious in hindsight, but in the moment, it feels calm, almost boring. The decision doesn't carry urgency, it carries inevitability. Story insertion. Traders who adopt this approach often describe the same sensation. When the day finally comes, they don't feel excitement, they feel relief, as if they're finally allowed to do the thing they've been holding back from doing poorly. Execution improves because energy hasn't been wasted elsewhere. Risk is sized with respect, not bravado. Stops are placed without argument. You're not trying to make something work. You're responding to something that already is. Ignore this lesson, and the consequences are predictable. You stay active, you stay busy, you mistake engagement for progress. Capital erodes slowly, then suddenly. The market teaches the same lesson again at a higher price. Another interrupt. Silence pause. 2 seconds. Now comes the part most people overlook. Learning accelerates when you trade less. With fewer trades, feedback is cleaner. You can isolate cause and effect. You review without defensiveness because there's less emotional residue attached to each decision. Over time, your system evolves, not through constant tweaking, but through reflection. You stop reacting to losses and start understanding them. You notice which environments reward your approach and which quietly punish it. This is where Jesse Livermore's experience still echoes. He understood that adaptation wasn't about adding tools, it was about removing behaviors that no longer served him. Waiting became the discipline that made learning possible. Lifestyle shifts follow naturally. Stress declines, not because markets become easier, but because exposure is intentional. Relationships stabilize. Sleep improves. You're no longer carrying unfinished trades in your head every night. The market stops being a constant companion and returns to being a place you visit with purpose. Pattern interrupt. Question, softly. If your trading improved, but your life didn't, would you call that success? The 5-day month does something subtle. It returns agency. You're no longer organized around the market schedule. You're organized around your own standards. Trading fits into life instead of consuming it. There's no clean ending to this lesson, no final mastery point. Some months you'll trade more, some less. The number isn't sacred, the selectivity is. Livermore never claimed patience was passive. In his framework, patience was the most aggressive stance possible because it preserved capital, clarity, and conviction for the moments that mattered. The market will open tomorrow. It always does. Opportunity will come again. It always does. The question that remains isn't whether you'll be there, it's whether you'll wait until it's worth being there.